Hey everyone, welcome back to Canada Accounting Insights. Today we're diving into the foundation of audit and assurance. We are going to cover elements of an assurance engagement, types of engagements, stages of audit, and more. If you're getting ready for the CFE, you must review all these concepts before your exams. Before we start, make sure you hit like, subscribe, and turn on notifications so you never miss a lesson. All right, let's jump in. Let's begin by grounding ourselves. What exactly is an assurance engagement? In simple terms, assurance is all about building confidence. A practitioner, usually an auditor, is engaged to evaluate something and express a conclusion that gives users more trust in the information. But what actually makes something an assurance engagement? To answer that, we need to walk through the 5 essential elements. So let's transition right into those. Every assurance engagement has 5 must-have ingredients. If even one is missing, it's not assurance. 1. Three-party relationship. You need the practitioner, auditor, the responsible party, often management, and the intended users, like shareholders, lenders, suppliers, the public, etc. 2. Appropriate subject matter. This can be financial statements, KPIs, internal controls, environmental data, compliance results, anything that can be measured or evaluated. 3. Suitable criteria, such as IFRS or ASPE, COSO, environmental regulations, legislation, contract terms. 4. Sufficient appropriate evidence. This is where the auditor collects proof, tests information, and exercises professional skepticism. 5. A conclusion. The auditor expresses a clear conclusion, usually in the form of an opinion. Now that you know the framework, let's bring this to life with an example. Imagine EcoFlow Chemicals Limited, a large manufacturer beside a river. EcoFlow wants an assurance report confirming that its wastewater meets environmental standards. Let's test whether this is an assurance engagement. Three-party relationship? Yes. The auditor, EcoFlow, and users like shareholders and the public. Subject matter? Harmful chemical levels in the river. Criteria? Provincial environmental regulations and industry benchmarks. Evidence? Water samples, lab results, inspection of filtration systems, and environmental reports. Conclusion? A formal assurance report. Since all 5 elements are present, this is an assurance engagement. Now that we've seen what assurance looks like in practice, let's talk about why assurance engagements exist in the first place. There are 2 huge economic reasons why assurance exists. 1. Agency risk. Owners and managers don't always share the same incentives. Management might present information that benefits them, not the shareholders. Assurance helps bridge that gap. 2. Information risk. Users rely on information they didn't prepare. Errors, complexity, fraud, and bias can all distort the picture. Assurance reduces the chance users make decisions on unreliable information. With that foundation in place, let's see the different types of assurance engagements you'll encounter. Assurance can apply to financial or non-financial subject matter. Here are some financial assurance examples. Audits of financial statements. Reviews of interim financial information. Non-financial assurance examples are internal control audits, environmental audits, technology audits, ESG reporting assurance, compliance audits, fraud investigations. Non-assurance engagements, important distinction. These don't include all 5 elements, like for example, compilations, agreed upon procedures, consulting, and tax prep. So, an audit is an assurance engagement. But not every engagement provided by a CPA is assurance. Now that we know the types, let's talk about the level of assurance each one provides. Not all assurance engagements provide the same level of comfort. Reasonable assurance, high level, provided by audits. The auditor gathers significant evidence to support a positive opinion. Limited assurance, moderate level, provided by reviews. Expressed in negative form, nothing has come to our attention. No assurance, provided by compilations and advisory work. Now let's zoom into the most powerful and most regulated assurance engagement, the audit. Per KS 200, the purpose of an audit is to enhance the degree of confidence of users by providing an opinion on whether the financial statements are prepared fairly, in all material respects, in accordance with the applicable framework. But not every entity is required to be audited. That brings us to our next topic. There are two types of audits. 1. Statutory audits, required by law, for example, public companies, some government organizations. 2. Voluntary audits, performed even when not required. Private companies, charities, and not-for-profits often request them to satisfy banks, boards, or bylaws. The goal is always the same: credibility. Now, how do auditors actually perform an audit? They use something called the risk-based approach. Under the risk-based approach, auditors focus their work on the areas most likely to contain material misstatements. For example, at Maplestone Industries, the controller was away for the last 3 months of the year with no replacement. The auditor would increase testing in that period because the risk of error is higher. This approach has advantages but also limitations. So let's look at both. Benefits are more efficient use of audit hours, better insights into internal controls, ability to perform some work before year-end, higher audit quality, earlier detection of issues. Limitations are audits can never provide absolute assurance, management override can hide fraud, judgment is required, which introduces subjectivity, time and budget constraints exist. Understanding these limitations is important, especially when we discuss the roles and responsibilities in an audit. Management is responsible for preparing the financial statements, designing internal controls, ensuring relevance, reliability, comparability, understandability, providing access to information. Auditors are responsible for being independent, applying professional skepticism, gathering evidence, complying with CASS, expressing an opinion. Management prepares. Auditors examine and opine. Despite the clear boundaries, many people misunderstand what auditors actually do, and that brings us straight into the expectation gap. The expectation gap is the difference between what the public thinks auditors do versus what auditors are actually responsible for. Common myths include auditors guarantee the statements are correct, auditors detect all fraud, auditors prepare the financial statements. To reduce this gap, auditors rely on two tools. 1. The engagement letter. 2. The auditor's report. With responsibilities clarified, let's walk through the actual stages of an audit. An audit has 4 major stages. 1. Acceptance and continuance. Should we accept or continue with this client? 2. Planning. Understand the business, assess risk areas, and build the audit strategy. 3. Execution. Perform detailed testing, analytical procedures, tests of controls, and substantive procedures. 4. Completion and reporting. Finalize conclusions, obtain management representation, and issue the auditor's report. And throughout these stages, auditors now frequently use Audit Data Analytics. A DAS allows auditors to analyze entire populations, detect unusual patterns, and test transactions more efficiently. Benefits include better insights, higher evidence quality, ability to analyze 100% of transactions, improved client service, potential cost savings. Now let's look at where all of this work comes together. In the Independent Auditor's Report, here's an example of the Auditor's Report issued for North Peak Technology Corporation by BrightPath Assurance, LLP. The report must include title, addressee, opinion, basis for opinion, key audit matters, other information, responsibilities of management, responsibilities of auditor, auditor's signature, auditor's location, date. This format ensures consistency and transparency for users. Now let's finish with the types of audit opinions. There are 4 possible audit opinions. 1. Unmodified opinion, clean, statements present fairly. 2. Qualified opinion, material but not pervasive misstatement or limited scope. 3rd, adverse opinion, material and pervasive misstatement. 4. Disclaimer of opinion, not enough evidence. Potential misstatement is material and pervasive. And with that, you now fully understand every major component of assurance and audit. Before we wrap up, let's quickly highlight the key takeaways from everything we covered today. These are the essential points you'll want to lock in for your CPA exams and your practical understanding of assurance and audit. 1. Assurance equals confidence. Assurance engagements exist to give users more confidence in information. whether financial or non-financial. 2. Every assurance engagement has 5 required elements: a 3-party relationship, subject matter, suitable criteria, sufficient appropriate evidence, a conclusion. Miss one, it's not assurance. 3. Assurance exists because of risk, agency risk, managers versus shareholders, information risk, errors, fraud, complexity. Assurance reduces both. 4. Types of assurance engagements vary: financial, audits, reviews; non-financial, environmental audits, internal controls, governance, etc. Non-assurance, compilations, AUPS, consulting. 5 levels of assurance: reasonable, audits; limited, reviews, none, compilation/advisory work. 6. Audits follow a risk-based approach. Auditors focus on areas with the highest risk of material misstatement, not every area equally. 7. Roles are clear and distinct. Management prepares the financial statements, designs controls. Auditor examines evidence, applies skepticism, expresses an opinion. 8. The expectation gap still exists. Auditors do not guarantee accuracy, detect all fraud, or prepare the financial statements. 9. Stages of an audit: acceptance, planning, execution, completion, and reporting. 10. ADAs enhance audit quality. Audit Data Analytics help auditors analyze full populations, detect anomalies, and strengthen evidence. 11. Audit opinions. Come in. 4 types: unmodified, qualified, adverse, disclaimer. Each tells users something different about financial statement reliability. 12. The auditor's report has 11 required elements. From the title and opinion to key audit matters and the auditor's signature, the structure is standardized for clarity and transparency. And that wraps up today's deep dive into assurance and audit. If this video helped you understand the foundations of assurance and audit, or if you're studying for CPA exams, make sure to like, subscribe, and comment which topic you want me to break down next. Thanks for watching Canada Accounting Insights. See you in the next lesson.